All right. So, Josh, you've got a combination of credentials that are genuinely, rare to some of the people coming in. So, I know you're CFP, EA, Certified Exit Planning Specialist. And rather than walk through what those mean on paper, I want to get into what they mean in practice. Um, First, quick background. Who are you? How did you end up here?
Yeah, so obviously Josh Bennett, but I have been in the sort of finance world for 15 plus years, doing everything from financial planning, tax preparation, and everything in between, both for high net worth individuals as well as business owners and businesses directly. So I started my career in actually one of my mentors. I started at Schwab. One of my mentors along the way was actually the guy that like Chuck Schwab would send his friends to, like his billionaire friends. So I sort of saw complex tax strategies, from the beginning of my career, and I've been fascinated ever since. So ended up getting my, certified financial planning designation, my enrolled agent with the IRS, and my certified exit planning specialist designation. But like all amongst trying to basically be able to help clients through very complex situations, whether that's mitigating taxes, understanding complex situations with businesses or estate plans, and being able to understand like all the variables that play in. Because like it's not just one of those things like where you can make very myopic decisions from a just tax only. Because like decisions we make on the tax side can impact the estate planning or can impact your business, or decisions you make on like a entity setup standpoint from your business can affect how you raise capital. It can affect how you pay taxes. It can affect all these different things. So really having a full view of how to help people in the best possible way with whatever their financial situation has been my goal my whole career. And I mainly do that mostly through helping like on the tax side, as well as like with like business owners directly helping, in terms of like entity setups, as well as like fractional CFO work, bookkeeping. So sort of making sure like, hey, your finances are good and compliant, and you're able to understand your financial picture both in your personal life and in your business to then be able to make sure you're reinvesting your money adequately and reinvesting well and have very deep knowledge on what your situation is. Um, kind of
Solid. Yeah.
there, but
It's a great perspective, man. And most people's CPA went to accounting school, learned to file returns essentially, but you're coming at this from a financial planning, you're a CFP first, thinking about income, retirement, investment returns, how everything interplays before you ever even touched the tax return. So for someone who's been working with the same CPA for years and feels like their taxes are handled, right, to the best of their ability, what are they probably not seeing that you tend to see?
yeah, I think you hit the nail on the head. It's the planning side. So I kind of came into the industry the backwards way that most people do. Most people get the very academic, like, hey, here's how you file a return, or here's like tax law, and then they become a CPA or they become an EA or they, get into the tax world or accounting world. I came in planning first, and so I sort of learned it all in reverse, where I had to find out like, okay, here's how these tax strategies and rules are applied in real life, and how what the implications of these tax rules are in real life. And then I had to reverse engineer basically into learning the implementation and the tax, you know, compliance and tax filing side of the world. Um, and so it was kind of a backwards approach. So the thing I think I see that a lot of CPAs and stuff don't is that full domino effect of what happens from data entry to actual implementation and what happens in the real world, right? And then also then how to pull these different levers and different strategies to then affect the return. Most CPAs don't see that, or they're too busy to see it, or they just don't have that perspective. And so I think that's something that's a big differentiator is coming from the planning side of things originally. Like it's sort of hard to rip that band or not rip that band-aid off. Like it's something whenever I look at a return, whenever I look at a tax situation, I'm always looking at it from like a planning perspective first.
So
Um,
it's important. It's kind of in the teams we said plan your dive, dive your plan, right? It's like if you don't have that plan in place, you don't know what you don't know. You're kind of winging it, and there's just tons of inefficiencies that come out. And even like, I'm curious, working alongside like tax attorneys, estate attorneys, other financial advisors, maybe even existing CPAs. What do you see kind of breaking down when those people aren't coordinating as a team versus what it looks like when everyone's singing from the same page?
Lots can break down along the way. Like this was so actually when with my CPA designation, this was one of the things that I found very valuable with that designation that's not brought up enough, in my opinion, is the importance of, especially with complex situations, having different position players, if you will, all in coordination. So I'll use a business sale as an example. Like in that, exit planning, they talk about like you should have your attorney, your accountant, your lawyer all working together for like 3 years before a sale because like yeah, it can take time to prepare these things. And this, I'm using this as an example, but it can be on any scenario. But like for example, with an exit plan, well, there's tax strategy obviously because if you sell it for a big ticket dollar, you're probably gonna owe taxes. But there's a bunch of different ways where you can mitigate or defer that tax bill. Some of those may, for example, involve things like an installment sale trust. An installment sale trust is basically like, let's say, Mark, you came and bought my business for $1 million. Well, instead of me just getting $1 million and then paying a big tax bill, I can say, okay, I'm going to pay that $1 million over 10 years, right? Well, I need a good attorney to put that installment sale trust together. Otherwise, that tax strategy doesn't work, right? And so I need to be in coordination with them to make sure I'm managing on the compliance side, they're managing on the legal side, that we're both keeping the client very informed of the compliance of what the do's and don'ts to make sure they maintain the integrity of that installment sale trust because there are like rules they have to follow, right? So that requires a lot of coordination between me and an attorney. Same with like, but within that installment sale trust, you can also invest the money. So to make sure like they're not just having money sitting there useless for 10 years, it very well, and what that implications could be on somebody's estate plan could mean, okay, bring in their estate plan attorney, bring in their financial planner to make sure that that money gets invested within the rules of the game, that of what the attorney says is allowed, and all these different factors play into that one strategy. Not even like talking through other complexities that may be in that same sale, but just in the evolution of that one strategy, you need all four players involved. Um, and so tight coordination amongst professionals that have one work together well, know how to communicate with each other, when to communicate with each other. Like that's a very critical thing.
100%. Yeah, and I know it can sound pretty technical, to people outside of this field, but ultimately what it boils down to is who's in the room ultimately matters a lot. The team that exists or doesn't exist is huge in terms of the impact or the cost that it's going to accrue for someone, right? So the team matters. And again, just reflecting on my background, the like having good members on your team that know exactly what to do, how to move, how to think in their own domain, but can sync back up and work as a team instead of individuals is huge.
Yeah,
Kind of to
you
pull
don't have
on
a good
that.
team guy. That's a
Yeah.
pretty important thing.
Yeah, 100%. And just to pull on the thread a little bit more on the exit planning, right? Like, you know, um, what does it actually look like to, when a business owner comes to you and says, "Hey, I want to sell in the next few years." Like, what are the questions most people haven't thought to ask yet?
Like, doesn't make sense. Like, and what are you gonna like, do after? Like, this is part of the planning piece of the puzzle, but like there's a bunch of variables that matter qualitatively other than just the dollars and cents too. Because a lot of business owners really struggle with finding purpose after retirement. Now and that factors in a lot to like then what strategies makes sense from a tax perspective because if it's like, hey, we're going to just lock up your money, you have nothing to do, like like it can really affect you psychologically after an exit. Um, that's a big factor. Can you financially exit? So like a lot of business owners look and say like, hey, I'm going to basically sell my business and I'm going to retire because they may see the valuation of a business like top level, but then they don't factor through the taxes and what that actually translates to in a retirement. But like you're going to bleed that money down if you're not making any other money or if it's not earning interest. And so really understanding of like, hey, here's the lifestyle I want to maintain after I sell my business. Here's the money that I'm going to need to functionally fund that. How's that coming? What are the taxes coming from that? Or what's the net that we're getting to actually fund our lifestyle after a business sale? Like all those variables have an impact, but most people just sort of see the top level number, or just get burnt out and get or done or whatever the case may be, but they don't actually think through the strategy of like, hey, if I leave this, can I retire? And if I, assuming I sell it and do retire, what am I going to do about my life?
Yeah, all super important questions to ask, and if you don't know to ask them, you don't know to think about them. Someone gets into a more reactive situation. Another thing I wanted to get your insight on, right, is something that seems to confuse even pretty financially sophisticated people is income character, right? So the difference between ordinary income, passive, and capital gains, and why it matters which bucket something falls into. Can you just kind of, break that down plainly and explain why, getting that right is, one of the highest leverage things someone can do in planning?
Yeah, and it tends to not follow always common sense because there can be things that like can be a business in one use and passive in another. And so, really understanding the character is where a lot of tax strategies and tax rules really ultimately stem from. Yet at the end of the day, you have basically, active and passive is kind of the way everything boils down to. So, like you think of, okay, I go to my W-2 job, that's active income. I'm an active business owner. Any money I make, net of expenses, that's active income. A rental property that I have a tenant for, um, that, as a year long tenant, the IRS may view that as passive. Dividends and interest, passive. Even if you have like, it's less of a rage these days, but like there was a rage of like, passive income businesses. Well, even if it's a business you barely work in, that could still be considered active. Even though it may be less passive than your rental property. Like you may be doing more for your rental property, but it's passive. And so, really understanding how the IRS interprets your income affects the tax strategy. And the reason being is like, for example, like let's say we do a cost segregation analysis on a rental property. So what that essentially translates to is you get a sort of create a bunch of expenses for your rental property to drive a big loss on paper, for that property. So like, let's say I'm making $500,000 in my W-2. I have this rental property and now I have $100,000 loss. Well, if it's a passive loss, I can't use passive losses to offset active income. I have to have passive income to offset passive losses. Whereas if I can all of a sudden turn this into active income, now I can use that loss to offset my W-2 income and drive my tax bill lower. And so that's where the character of income really factors in, is because to do these kind of tax strategies, you need it to be sort of like for like. And same with like if you have uh, active deductions, it may not offset passive deductions. Um, so so that's where the character really matters.
Yeah, there's a lot of nuance to it, right? And there's also interpretation of words and terms that have certain legal definitions and common definitions, and that's a source of confusion. So when we're thinking of, passive strategy, there's a segment of people who want to reduce their tax burden, but they don't want to become super involved real estate operators. They don't want to manage tenants and evictions. They don't really want that active management, what they perceive to be that, right? They just want their money working more efficiently for them. So, what are the legitimate options that exist actually for someone like that?
that want more passive, you know,
They want more, yeah,
less
like
involved.
nearly passive, almost passive, not necessarily how the IRS views passive, but in effect and implementation that money's working for them versus them having to turn wrenches and create another job basically.
Yeah, there's the biggest way is like there's always like opportunities that sort of exist within the tax code, generally around some sort of strategic investment. The way the whole tax codes are written is they want to incentivize some sort of action from us as taxpayers, whether it's invest in clean energy or invest in property or whatever the case may be. Usually, to have things that are less involved, they generally require some sort of strategic investment. So, like an example that I use a lot is like there's a lot of tax incentives around investing in movies, which most people don't know about. But you can get some very good leverage tax benefits from investing in movies. You can get very good tax benefits from investing in oil and gas, investing in solar and clean energy, investing in like software. There's or just kind of getting creative with charitable donations. There's a lot of different things that you can do that are more passive that have pack a sort of a big punch from a you know functionality standpoint or result standpoint. Um, it just kind of depends. Like there's for most people, it's just a matter of what makes the most sense to them and their lifestyle and their risk, that they're willing to take within their business. But the tax code is pretty wide and deep of like what options do exist. And there's a reason that like you hear the stories on the news of like, hey, Trump is a billionaire that paid $800 in tax, right? Well, it's because
Yeah.
there's a lot of tax strategies that exist that can get that zero, and those exist for every person. It's just a matter of what makes most sense for that individual.
Yeah. And on that, I know real estate is a big one that comes up because it's, one of the best wealth builders out there. It's constantly showing up with high earners, either as an existing asset or a strategy that they're considering or heard about. But it also comes with a fair amount of, hesitation, lack of clarity, uncertainty. So when most of them think they have an understanding, good or bad, about real estate and how it works, specifically from a tax standpoint, what do they usually have wrong?
Could be a lot of things. So real estate can be an extremely powerful thing, but from a tax perspective, from a wealth building perspective, all of the above. But where I think people get like tripped up with real estate is they just view it like real estate, one category, simple as that. Well, to put in perspective, there's like 7,000 stocks in the US stock market. There's 80 million homes and like another $20 million or 20 million commercial properties in the US. Every region, city, neighborhood has different components for that individual property, whether it's the community, whether it's the traffic, whether it's the, you know, political spectrum within that area. Like real estate can be incredibly deep and complex. And the tax codes then on top of that make it even more so, because there can be strategies with where it can be active and passive, even if the logic doesn't necessarily follow which route it is. And beyond that, it's okay. There's a myriad of components within there, like that can be cost segregated, that can be turned, like if it's a primary residence versus a rental property versus a short-term rental, like all those have different factors, all of which can lead to incredible tax benefits, all of which can lead to great wealth building benefits. But there's a ton of nuance, and that's where a lot of people like frankly try to simplify it. But because there's so many variables, that it's very hard and challenging to simplify into like a yes or no binary, like this is the right thing, if that makes sense. And
Yeah.
that's like, working with a professional that has the experience or like has seen all these different variables and, makes a lot of sense.
Yeah, I mean, and I know we're getting close to time here, but if you got a couple minutes, just get a few more questions. You know, a lot of people, everyone's heard about tax strategy before, maybe from a guy at a networking event or an ad online, right? Oftentimes they're skeptical, reasonably, um, because what's getting sold in this space might feel too aggressive or vague to even be real, right? So, how do you think about the difference between sophisticated and defensible versus aggressive and risky?
That's a really good question. There are definitely like a lot of strategies out there that, and a lot of what it's called like sort of nefarious actors in this field, that are more like get rich quick schemes. But and those definitely should be avoided. But there's a difference between being aggressive and, you know, doing something like fraudulent, if that makes sense. And the way the tax codes are written too is like everything in the tax codes tends to start very vague, because politicians don't like to have specificity. And so what then happens is basically people use different strategies or interpret these tax laws. And then over time, there's court cases, there's IRS rulings, there's all these things that then ultimately turn it into a very, specific use case that is very concrete. Like 401k is a prime example. Like the rules for a 401k are well established. A 1031 exchange, well established. Like all these different tax rules that have been used, hundreds of thousands, millions of times. Like those are, there's no ambiguity. On the crypto side right now, there aren't any rules. Really, no one has any clear idea of what the tax laws will be with that. So even within crypto, you can, try to take very conservative interpretations of the rules, or interpretations based on like, hey, this transaction very much seems like this other transaction, which is well established, and you can make decisions that way. But then ultimately, Congress and the IRS and whoever else can determine down the road, like, nope, you interpreted it wrong. Fix it. So like, even if you are more conservative, like, yeah, crypto can still have more, be more aggressive or have more risk just by the nature of that there's not as well established tax rules. And that's how a lot of these tax strategies work, is they, maybe based on or, part of like interpretations of the tax law that just may not be well established yet, even though they're well backed in, case law or studies or whatever the case may be. They may still be more aggressive, just be by definition of like they haven't had enough, reps, if you will, to like have clear, very clear court rulings and things like that yet. So that's where like there's a difference to me between something that's like backed and well interpreted within the tax rules versus like, hey, I just sort of made this up, which is
Yeah,
a lot on like TikTok or Instagram of just like completely made up tax rules. There's a big
tons of
difference
that.
between those.
Yeah, tons of that. Yeah, and that's a great perspective here. And I mean, just last one here for you is the people who actually end up changing their tax situation and get, the best results versus the ones who've been kind of, thinking about things for years and years and haven't pulled the trigger on anything. In your experience, what's actually different about them?
Mostly just action. Um, I mean, again, it can be very scary doing a lot of the different tax strategies because, again, a lot of them involve some sort of strategic investment. Like I'll even use like a common one like 401k. Like it can be, if you're depending on what your income is, it can be scary, locking up an extra, up to 70K a year into like a solo 401k, that you can't take your money out of until you're 59 and a half without like penalties and interest. Like, and then some other strategies may require, $100,000 investment. Like it's scary writing that check. But that's where the actions ultimately equal the results. And just sort of nothing ventured, nothing gained. So that's where, the biggest difference between people that are successful with like tax mitigation strategies, and the ones that just frustratingly pay their tax bill is just basically getting very comfortable with taking action in some regard. And there's a spectrum of that risk too out there. And so like finding, or working with a professional to find like where you're comfortable with on that spectrum, and basically getting to that line is, I think, where the difference between success and not is, basically using whatever strategies are at your disposal or within your means that you can get comfortable with.
Perfect. Well, appreciate it as always, Josh. Always a pleasure talking with you, and I appreciate you breaking things down from your perspective. Yeah, hopefully this is going to be valuable for anyone kind of thinking about changing behaviors to get the results that they ultimately want. So appreciate you and your time, man.
Yeah, my pleasure, Mark. Yeah, of course. And appreciate you as well.